Welcome to the next edition. So far, what I have talked to you is to give you a very generic background about the course, foundations or fundamentals of accounting and finance. What we talked about? We talked about the different components, like we talked about what is financial accounting, who are the potential users of financial accounting information, what is cost accounting, who are the potential users of cost accounting information, and when we say finance, what do we mean by finance? So, it basically, if you talk about accounting, it revolves around only these two, financial and cost accounting. If we talk about finance, it revolves around only sourcing and investing money. So, that is what we talked about in the last so far. Out there, I have given you various situations under which you will use decisions you will take, you possibly can make using the cost accounting information. You also talked about the corporate finance part of it, where we talk about investing money, sourcing money, and so on and so forth out there, and so on. Now, just to move ahead in this particular case out here, we will deal a little more. Now, since that I have given an overview, I am going to deal a little more with each of these aspects out there. As I talked to you, we said that we will deal with about 40 to 50% of the course will be about financial accounting, that is recording and assessing the financial position of the enterprise. Then about 20% will be on the cost accounting information and 30% will be on the finance part. So, we will start with what we call it as financial accounting as of now today. Now, what did I say? First, primary job, financial accounting, recording transactions as and when it happens. Now, a typical accounting course, if I look at, they would walk you through the process of recording the transaction, stage by stage out there, and then finally end up with the financial statements out there. Now, I am not going to do that, though I will spend a few minutes on the various, on the process of recording the transaction and consolidating these transactions. We will deal with the final financial statements, the end financial statements out there, only more and more of that in this particular course. Now, normally, what is the process? To give you just an overview of the whole thing, moment a transaction takes place, it is recorded in the books of accounts. The first book of account which they would normally use to record is what we call as a journal. That is, as and when the transaction takes place, it just gets recorded out there. Manually, it used to get recorded. Today, you have the software where you have Tally and various other packages out there. You just enter the transaction, it automatically takes care of it. We will come to that in a little bit of more detail as we go on. The next stage of this is the transactions are grouped out there at some periodic intervals out there, and when they are grouped out there at some periodic intervals, it is grouped in the next book of entry called as ledger. And then the third stage, what happens? They consolidate it and prepare what is called as a trial balance. And then comes the financial statements out there, basically the final financial statements which are prepared to assess the profitability or the financial position of the company out there is a result of, after all these three statements are prepared, then they come out and basically prepare these three core financial statements out there: the profit or loss account. The other way is they also call it income and expenditure account. Prepare what is called as the balance sheet. Third is what happens is what you call it as the cash flow statement. Now, what are these? What are these? Profit and loss, balance sheet, cash flow statement. What is this? Something you have written up front. I mean, you have written above that. That is journal, ledger, trial balance, etc., etc. Now, let's spend a couple of minutes in understanding these things out. And then I will take up a few examples pertaining to P&L, profit and loss account or income statement, balance sheet and the cash flow statements. We will take up a few examples. Now, when I said in this particular case, I talked about, that is, I talked about what is called as a journal, ledger and a trial balance. In an organization, let us say, number of transactions keep happening. You, for example, let us say that you buy a product. Immediately this happens, let us say at 11 a.m. 11:02 a.m. you sell something. 11:05 a.m. what happens? Somebody to whom you have sold goods in the last month, what do you call it as? You receive cash on a old sale. Now 11:10 a.m. what happens? You sell goods again on credit. Here let me say sell for cash, buy a product for cash. Now 11:15 a.m. you withdraw money from the bank. So what is happening? I've just given you some roughly about 5 different transactions that has happened. Moment each transaction happens, I record these transactions. That is, I will say, now I buy a product, that means the inventory what I have is increased. I have bought the product for cash, then what happens? The cash balance comes down. This is as far as the first transaction is concerned. Now let me take a second transaction. I sell goods, that means what happens? My inventory has gone down. My cash has gone up. This is as far as this transaction is concerned. This is, let me say, cash, my inventory. In this case, my inventory, my cash out. Now let me go to the third transaction out there. Let me go to the transaction. Receive cash on a old sale. That means what? My cash balance that I have has increased. The receivables from that fellow from whom I have to get has come down. It is, I have come down. That is, the receivables have come down. So what is happening? Moment a transaction happens, I am recording it. Not in this way in the form of arrow, but you record it in the form of a statement with corresponding debits and credits. Let us not even get into debits and credits. And that recording of this is what we call as a journal. That is what happens in a journal. We just record this transaction. I've taken you 3 examples out there. That is, first example, I buy a product, my inventory increases, my cash goes down, I record it. Second transaction, I sell, my inventory decreases, my cash increases. Third transaction, what happens? I get a cash, my cash balance increase, the receivables and old basically reduces out there. So what happens? I've recorded 3 different transactions out there. The process of recording these transactions is what I do when I say I do it in a journal. So this is recorded in the form of debit and credit out there. I would say, how do you do it? Let me take the example out here for the first one. Buy a product for cash. That means what is happening? Purchases account debited to what is called as cash account out there, that is, which is basically credited out there. That is all. That is basically how. Sir, what is this debit credit? Don't worry about debit credit as of now. Without debit credit, we will try to learn accounting out. Without learning debit credit, we will try to learn accounting. So, this, the way in which I have showed it out here, this is what we do when we record in a journal out there. Transaction is there, I will keep on recording. One after the other, I will keep on recording in what is called as a journal. Then what happens? The next book of account. Then what happens? What is the next book of account out there? You talked about something called as a ledger out there. Now, what does a ledger do? Now, in this particular case, in the earlier case, in this earlier case, whatever we did out here, cash was getting impacted in the first transaction. Cash was getting impacted in the second transaction. Cash was getting impacted in the third transaction. So, the cash is getting impacted in all these transactions. The inventory is getting impacted in the first transaction and the second transaction. So, what do? I group them together. I group them together to know what is the inventory, to know what is the cash position out there. Like, for example, what did I do? Let me say cash. What do? I say cash account. Now, I said I have received cash. When I have received cash, what happens? My cash balance basically increases out there. That is, if I say in the first transaction, what do? I pay cash to buy. What is this DRCR? Or debit credit. Don't worry about that. I pay cash to buy. Then what happens? To basically what is called as to your purchases, whatever is the cash you have gone down. I have sold for cash, buy, sales. What happens? There is a cash amount which is there. I have received a third transaction. I received cash on the old sale, received receipt of buy receivables. Again out there. So, what have I done? I have grouped all the transactions relating to cash together. That is, whatever I have received, I have recorded it on the right side. Whatever I have paid, I have recorded it on the left side out there. Now, I want to know what is the cash balance as of today. All that I have to do is, I have to sum this up and then find the difference between these two. Then, whatever is the difference I have is the cash that I will basically have out there. Imagine this is about 1 lakh. This is about another 50,000 and this is, let us say, is about another 75,000 out there. That means 1.5 lakhs minus 75,000. That means my cash balance has to be 75,000. So, I will know. So, what have I done? I have grouped it together. I have grouped it together. Now, let me go back to my inventory example also, the other one out there, inventory. What did I do? I bought inventory. Bought inventory for how much? I bought inventory, that is, I made a purchase. I bought inventory for about roughly 75,000 by cash. How did I buy? I bought by cash. I sold inventory for already about 1 lakh out there. I sold for already almost about 1 lakh out there. Sir, can you have negative inventory? No. I cannot have. Maybe there is already a balance of inventory. That is, there is always an opening balance of inventory left over from the last month. Let us say about another 50,000 out there. Opening balance of inventory. So, what happens? What is the inventory position as of today? 75 plus 50. Opening, I started with a balance of 50,000 inventory. Like this one, last month. I bought for about 75,000 worth of inventory. That means I totally have an inventory of 1,25,000. I have sold inventory for 1 lakh out there. I have sold inventory. That means my balance inventory as of now is about 25,000. So, what have I done? I have grouped these accounts together and I can find out the position of each of these, my inventory, my cash, etc., at any point of time out there. And this process is what we call it as a ledger out there. So, the first process or the first book of entry is what we call journal. As and when transactions keep taking place, I keep on recording, writing it, typically erstwhile. Then at every frequent interval, maybe at the end of a day, maybe at the end of a week, depending on the size of the organization, maybe at the end of every month, maybe at the end of every fortnight, depending on the size of every organization, what do? I group them together like what you saw, inventory, cash, etc., etc. And that process is what we call it as book of second entry, what we call it as ledger. Then we go into preparation of a trial balance and then etc. balance sheet and P&L and so on and so forth out there. Now let's keep this book of entries out there at this particular stage. Now let us move to the next stage out there. I'm skipping trial balance as of now. We will come back to trial balance a little later. We will move to the financial state. So having seen that, the recordings of financials, recording of the transactions, what is the purpose of the recording of these transactions? To know the financial position of an enterprise or an organization. Now, how do I know the financial position? Can I know the financial position by with the help of these kind of groupings what I have done? Can I know the financial position with these kind of entries that I have done? Well, no. I can assess the financial position only using the three basic financial statements. Ultimately, all this will have to result in the three basic financial statements as I had indicated, the profit or loss, and then the balance sheet. And then the third one, the cash flow statement. Any annual report of a company, you pick up the annual report. Today it's all in soft copies. You will find these three financial statements out there: the balance sheet, the profit and loss, and the income statement, and the cash flow statement out there. Now, are these three statements mandatory? Yes, the two statements out of the three are mandatory for every organization that is registered. The balance sheet and the profit or loss or the income statement. The cash flow statement becomes mandatory for every organization that is basically listed out there, that all the three statements basically become mandatory to be prepared at the end of every financial year. Let me repeat. It is mandatory to be prepared at the end of every financial year, and these will have to be audited by a professional auditor, the financial statements, and certified out there. Now, sir, you mentioned something financial. What is this financial year? Financial year. Now, we talk about calendar year, Jan to December. The financial year, we call it FY, that is financial year. In India is 1st April 1 to March following year, March 31st. This is what we call it as a financial year. When we say 22-23 financial year, that means April 1st 2022 to 31st March 2023. 18-19 financial year, April 1st 2018 to 31st March 2019. That is what we call it as a financial year. This financial year pertains to our country, India. Are financial years different in different countries? Yes. For example, you go to the US, the financial year is equal to the calendar year, Jan to December. You go to our neighboring country, Bangladesh, the financial year is from July to June. So, is it very different? Yes, it is different. In India, the financial year is April to March. So, we always denote the financial year is FY 22-23. That means financial year 22-23. So, all these three statements, the cash flow statement, the balance sheet, and the profit and loss or the income statement, is prepared for every financial year mandatory. Sir, I see financial statements for every quarter in the newspaper, sometimes it is published. Yes, it is open for the organization to prepare a financial statement every quarter. That is, if you take a financial year from April 1st to March 31st, obviously there will be 4 quarters. April, May, June is a quarter 1. July, August, September is quarter 2. October, November, December is quarter 3, Q3. Jan, Feb, March is Q4 or the end of the financial year. They can prepare it, but audited financial statement only at the end of the financial year out there. So we talk about these financial statements at the end of the year. So now question is, what does this financial statement tell me? What is the content of this financial statement? That will be the basic question that comes in. Now let us discuss the content of each of these financial statements out there. And then let us discuss the interactions between these financial statements. And let me go back to even describing how every transaction will impact these financial statements. Let me repeat. Let me talk about firstly what is the content of each of these financial statements. Let me talk about the interactions between these two financial statements, the three financial statements. And then ultimately, what is the purpose? How every transaction that takes place impacts the financial statements out there. Because all that you get to see as stakeholders will be these three financial statements out there. You may not get into the details of the journal ledger, which could be quite confusing. You will get to see these three financial statements, and obviously my job is to interpret the financial position using these financial statements out there. I repeat, my job would be to interpret the financial statement, interpret the financial position by analyzing these three financial statements. Interpret the financial position analyzing these three financial statements. If financial position can be known by these three financial statements, every transaction that takes place will have to impact this financial statement. Otherwise, how will you know? Every transaction that takes place will have to impact this financial statement. Only then you can analyze the financial position. So I will go to talk about three basic aspects out there. The first one being, what is the content of the financial statement of each of these? Next one being, how every transaction impacts these financial statements. The interactions between these financial statements, and then how every transaction is impacting these financial statements out there. Let us start with the first one, that is what we call it as the profit or loss or the income and expenditure statement. Is there any difference between income and expenditure statement, profit and loss? Well, there are, but by and large, we will say it is basically conveys or gives you the same information out there, and this is one of it. Profit or loss is for profit organization. They will always say for profit or loss account. Now, what will this record? This will record all the revenue and all the expenditure. That's all the revenue and all the expenditure. Now what happens? The difference between this revenue and expenditure, is what we call it as the profit or loss. That is difference between revenue and expenditure. That's all. So that is where it gives you profit or loss statement or income and expenditure statement. It gives you the income, it gives you the expenditure. It gives you the ultimate figure, the difference between the revenue and expenditure. It gives you the profit or it gives you the loss out there. So that is where it is called as profit or loss statement or income and expenditure statement. Sir, it's very easy. As the transactions happen, revenue I will keep recording, expenditure I will keep recording. But there is one catch here. What is that catch? We always follow what is called as accrual concept. ACCRUAL concept.